Hello everybody. In this session we are talking about cost of goods manufactured or COGM. The cost of goods manufactured or COGM refers to all the costs involved in producing a product, including direct labor, indirect labor, raw materials, and overhead costs. COGM is a useful accounting metric because it can be used to measure the performance of production and manufacturing costs with target costs. It determines the profit margin and other costs related to manufacturing or selling products. So, knowing this number is crucial for any business owner or manager. And then we move to the cost of goods manufactured formula. Calculating the cost of goods manufactured entails adding together all direct and indirect costs associated with manufacturing and also factoring in changes to the work in process or WIP inventory. This means that finding COGM entails knowing the total manufacturing cost or TMC of the manufacturing operation as well as the WIP inventory values for the beginning and end of the accounting period. The COGM formula is beginning work in process inventory plus total manufacturing costs and then minus with ending work in process inventory. And then how to calculate COGM. The first steps understand the COGM formula. Using the right formula is essential for getting an accurate COGM. The formula for calculating COGM is straightforward and involves simple calculation. And then the second steps, choose a period for calculation. Like most other financial calculations, it's necessary to select a specific period to calculation applies to. This can vary according to the type of organization for which you are calculating. For example, fast-moving stores that sell perishable products may want to calculate their COGM daily, weekly, or monthly. In contrast, larger companies or factories that produce more durable goods may calculate their COGM quarterly or annually. The third, determine your beginning work in process inventory. The beginning of a company is the value of products that are still in production. Companies and businesses can accurately determine this value at the end or start of a new business period. And then fourth, calculate your total manufacturing costs. The next step in the formula is calculating the total manufacturing cost for the period. The total manufacturing cost includes the cost of direct materials, labor, and other manufacturing overhead costs. And then we move to applications of the cost of goods manufactured formula. The first, cost control and management. By accurately calculating the total cost of production, manufacturers can identify areas of inefficiency, implement cost saving measures, and optimize resource utilizations. And then the second, decision making. The COGM formula plays a pivotal role in strategic decision making within manufacturing organizations. By understanding the total cost of production, manufacturers can make informed decisions regarding pricing strategies, production volumes, product mix, and investment opportunities. And then the third, financial reporting and analysis. The COGM serves as a critical component in financial reporting and analysis. It provides into the cost structure of the manufacturing process, aiding in budgeting, forecasting, and performance evaluation. And then fourth, inventory valuation. Calculating the COGM is essential for accurately valuing inventory. It enables manufacturers to determine the cost of goods manufactured during a specific period. This is crucial for inventory management, financial reporting, and tax compliances. And then we move to the difference between cost of goods sold or COGS and cost of goods manufactured or COGM. The cost of goods sold or COGS and cost of goods manufactured or COGM, despite sharing similar labels, are not the same. COGM as opposed to COGS, is attributed to units in productions and includes WIP and finished goods that have not yet been sold. Contrarily, COGS is only acknowledged when the relevant inventory is actually sold to a customer. For example, a producer might purposely start producing units earlier in anticipation of a rising seasonal demand. And cost of goods manufactured components. Production cost comprises three main components, namely direct material costs, direct labor costs, and overhead costs. Direct material costs include all costs associated with all materials identified as part of the finished product. It includes raw materials or semi-finished materials. Direct labor costs include salaries and wages for workers involved in the production process. They contribute directly to making the product. They may be machine operators or workers at assembly stations. Overhead costs consist of costs for supporting materials, indirect labor wages, and other indirect production costs. An example is cost of renting a production machines. I think it is enough for this session. Thank you for watching, and don't forget give this channel with your like, comment, subscribe, and share. Thank you.